Good evening, everyone. Time for another silver update. Now, this is the 10-minute chart of silver provided by netdania.com. You can click on the link below. Now, this activity here, I'm not going to put the volume in because I just want you to look at the price action here. Such dramatic price action and an indication here that we don't have anything to do with the fundamentals. So you can see, just looking at the dates here, back on the 27th, you can see that silver was at a price of about 16.47. That's right where we are right now, pretty much. Now, this swing, you can see the swing goes from about 14.4 to about 16.8. And that's about a one-day swing. That's nearly 24 hours. Now, if you do the math on that, you can see that's a $2.40 move in the price of silver within nearly a 24-hour period. And if you do the math, it comes out to be about 16.6%. So let's think about that in terms of another market. Let's take a look at the Dow Jones Industrial Market and think about those types of percentages. So if you do the similar translation here, and we're going to have to actually scroll out to where we get to the point where we can actually make that move. Because when we translate a 16.6% change in the Dow Jones Industrials, we're actually talking about a 3,000 point move. So we're talking about a move from 17,879 down to 14,879. So you can see that's not on the chart yet, so we have to go further out. We're going to go out until we get, and we don't have that on the recent correction, which you can see took quite a number of days. So we have to keep going out until we get to see a price of around 14,900. That's going to be the price target we're looking for. Okay, so you can see now we have that. That price is down here, 14,900. That's a price that we were trading at more than a year ago. Okay, so that's where we're at. That is the equivalent move in a 24-hour period in the silver market. So this is what this would look like. We'll go ahead and remove the arrows and bring this, hopefully we can bring this in closer. It's hard to do here, but that's about the best we can do. So if we're looking at an equivalent move on the Dow Jones Industrial Average in a 24-hour period, we're talking about the Dow going down to there, and these lines are going to be roughly equivalent, and up to there. It's not quite crossing over, but the equivalent on the other side would be like that. That's the type of move that you'd be looking at in the Dow Jones Industrial Average if it was moving in the same percentages that silver moved. That's what you would have. So is that a market? Is that a real market where silver is worth $16.50 one day, then the next day it's worth $14.50, and the next day it's worth $16.50? No, that's not a real market. That's not a market that has anything to do with the price of silver. There's nothing that's changed about people who manufacture using silver. There's nothing that's changed about people who mine silver. There's nothing that's really changed about people who invest in silver. There's nothing that's changed with silver. This is paper money driven. So I hope that's clear to you, because it's very clear to me. Now let's jump over to another chart that's really important here, and that's going to be the Russian ruble. Now we've seen incredible moves here in the Russian ruble. It's in kind of a parabolic formation. Let's do the 8-hour to get the best look here. So you can see that since about July of this year, we're talking about a 34, maybe 33.5 to 1 price, and we're all the way up to now touching up to about 50, almost cut in half. the Russian ruble cut in half in this time frame. Let's pull up the dollar index in the same time frame. An appreciation from about 79.5 to 88, so maybe a 10% move. The euro, a move down, not really significant. The British pound, a move down as well. Not that large of a percentage, but a pretty big one. And so those are the major currencies. We'll look at crude oil here because that's going to be the big one that is impacting the ruble. And you can see in that time frame we're talking about a big move in oil. So how does this all stack up? Well, we want to look at the trading economics site of the statistics for Russia. These are Russian foreign exchange reserves, and the question is why is the Russian ruble under such pressure? Well, I don't think the size of the economy is anywhere like the size of China or the United States, so it's very vulnerable to these raw exports, commodities like oil and natural gas. But again, there's clearly some type of currency war going on here. We can go through all the statistics for the ruble, but I don't really want to go through those because they're just not, the fundamentals don't justify what's happening to the ruble right now. And what's happening to the ruble is very, very close to economic warfare, would be the best way I could describe it. So the ruble, and if you remember, the Russian ruble was they had a major financial crisis. Well, it's not on this chart, so, but you can see that in comparison to the financial crisis, I showed you this chart before. We're in a financial crisis that is magnitudes larger, at least twofold magnitudes larger than the last financial crisis. So this is something big that's coming. Now, I want to look at the national debt because this is something I visit a lot, and this is something that has crossed a milestone, we'll say, because at this point here on the 28th of November, we crossed that $18 trillion mark. Now, if you remember when Obama was in office, this is the one year, this is the one that I always show you, but let's just go ahead and switch this to December 2nd of 2008 and just pull that for you. And you can see, there it is, about 10 trillion. So we haven't quite doubled, but nearly so. So if we look at that series of 1 year, we just pull December 2nd of 2013 to December 2nd of 2014. And you can see we started with about 17.235 trillion in debt, and that's a year ago. Now, it's going to be important to note here that it sat nearly the same for the entire month. So this may change dramatically, but right now what we're showing is 17.235 up to where we just recently hit 18. So we're talking give or take roughly $800 billion. So that's the rolling figure that we're looking at. A rolling $800 billion deficit that continues to add to this debt. Every year, 800 billion plus is added to this. So let's look at the latest article from Simon Black on Zero Hedge talking about this debt. This debt is staggering, and it's going to have massive implications. So this is 5 complete lies about America's new $18 trillion debt level, submitted by Simon Black of the Sovereign Man blog. On October 22nd, 1981, the government of the United States accumulated an astounding $1 trillion in debt. At that point, it had taken the country 74,984 days, more than 205 years, to accumulate its first trillion in debt. It would take less than 5 years to accumulate its second trillion. And as the U.S. government just hit $18 trillion in debt on Friday afternoon, it has taken a measly 403 days to accumulate its most recent trillion. There's so much misinformation and propaganda about this. Let's examine some of the biggest lies out there about the U.S. debt. 1, they can get it under control. What a massive lie. Politicians have been saying for decades that they're going to cut spending and get the debt under control. Fact, the last time the U.S. debt actually decreased from one fiscal year by the next to the next was back in 1957 during the Eisenhower administration. Fact, for the last several years, the U.S. government has been spending roughly 90% of its entire tax revenue just to pay for mandatory entitlement programs and interest on the debt. Now keep in mind that interest rates are at zero. So that's insane. This leaves almost nothing for practically everything else we think of as government. 2, the debt doesn't matter because we owe it to ourselves. This is probably the biggest lie of all. 2 of Social Security trust funds alone, OASI and DI, own $2.72 trillion of U.S. debt. The federal government owes this money to current and future beneficiaries of those trust funds, every single U.S. citizen alive. I fail to see the silver lining here. How is it somehow better if the government defaults on its citizens as opposed to, say, banks? 3, they can always selectively default on the debt. Another lie. People think that the U.S. government can pick and choose who it pays. They could make a big stink about China, for example, and then choose to default on the $2 trillion in debt that's owed to the Chinese. Nice try, but this would rock global financial markets and destroy whatever tiny shred of credibility the U.S. still has. Others have suggested that the government could selectively default on the Federal Reserve, which owns $2.46 trillion of U.S. debt. Again, possible, but given that the Fed, the issuer of the U.S. dollar, would become immediately insolvent, the resulting currency crisis would be completely disastrous. 4, it's the net debt that's important. Analysts often pay attention to a country's net debt instead of its gross debt. If you have $1 million in debt and $1 million in cash, then your net debt is zero. It washes out. Problem is, the U.S. government doesn't have any cash. The Treasury Department just opened its business day on Friday morning with just $71.9 billion in cash, or just 0.39% of its total debt level. Apple has more money than that. And number 5, they can fix it by raising taxes. No, they can't. Just look at the numbers. Since the end of World War II, U.S. government tax revenue has consistently been roughly 17% of GDP. They can raise tax rates, but it doesn't move the needle in terms of revenue as a percentage of GDP. In other words, the government slice of the pie is pretty consistent. You'd think with this obvious data that rather than try to increase tax rates, which is ineffective, they do everything they can to help make the pie bigger. Or better yet, just leave everyone the heck alone so we're free to bake as much as we can. But no, they have to regulate every aspect of people's existence. How you are allowed to educate your children, what you can and cannot put in your body, how much interest you are entitled to receive in your savings. All of this costs time, money, and efficiency. So do never-ending wars, the bombs, the drones, the airstrikes. This isn't about any single person or president. The problem is with the system itself. History shows that every leading superpower from the past almost invariably fell to the same fate. Great powers often feel that their wealth and success entitles them to spend recklessly and wage endless, arrogant wars. The Romans, the Ottoman Empire, the British. History may not repeat, but it certainly rhymes. And the lesson here is very clear. Debt weakens a nation. It weakens society. Generations that will not even be born for decades will inherit these debts by complete accident of birth. And the people in charge of the system have backed themselves into a corner where there is no way out other than to default either on their creditors, creating a global financial crisis, the central bank creating a currency crisis, or the citizens themselves creating an epic social crisis. And my bet is that's the one they're going to pick. Bottom line, this is not a consequence-free environment, and while you can't fix the debt problem, you can certainly reduce your own exposure to what happens next. So great summary there of what's going on by Simon Black of the Sovereign Man blog. Now let's look at this. I just wanted to have you take a look at this. This is 1981. This is when there was $1 trillion in debt. So let's go ahead and pull up the silver chart. We're going to get as much as we can, and you can see we don't get that figure. So let's go up and pull the more free charts, because those are the long-term charts of commodities. And let's pull up the silver chart and keep in mind the fact that we were looking at a $1 trillion debt in 1981. So back here in 1981, and this is after we'd fallen from a good 40 price in the price of silver, and you can see we touched that low of $5. So we traded anywhere between $5 and $15 and $5 and $10 for the next few years. But we know that since this date, the amount of debt in the United States has gone up 18-fold. But we also know that the price of silver, even taking the lowest spike there, has only gone up 3-fold. So what would the price of silver be if we're based on the low and we had 18-fold, where we're talking $90 silver? What would the price of silver be if this was an accurate measure here when we hit that 50? You can't see it because it's on the monthly, but we would be talking $900 silver. So if silver were anywhere near accurate and were priced based upon the amount of debt that's been accumulated, the price of silver would be anywhere between $90 and $900, and that's a good reason to keep stacking. And we'll talk to you next time.